My bank account is always empty. And no, I'm not broke. I'm actually earning about 4% interest on my cash, and I can get it in just 2 minutes if I need it. This is a value investor here. I help people save and invest intelligently. Here in the UK, the Bank of England rate is about 4%. Inflation is about 3.6%, and yet most high street savings accounts pay less than both. So, keeping too much cash in the wrong place could actually be costing you some money. My wife once asked me, why don't we just keep all our money in the bank? And in this video, I'm going to show you exactly how I answered it and how I balance savings and investing to grow our wealth. So here's the thing, savings are very important. You need them for emergencies, and short term goals. So if you're going to be saving for a house deposit, which um, let's say you want to get your house in about a year's time, you can't take that money and invest because investing will require a longer time frame. Savings will actually include your emergency fund. The emergency fund should have 3 to 6 months essential expenses. So you might have an emergency fund which will have 6,000 to about 12,000 pounds, and then you will need fast access to that money because if anything happens, if your boiler breaks down, or if you have a car breakdown, or your car fails MOT, you need to quickly get that money and use it to cover those emergencies. So you'll need somewhere where you have fast access and somewhere where you don't have market risk, where the value of that emergency fund portfolio drops in value because you will need to liquidate your position, and doing that at a loss is not ideal. I normally put our emergency fund in a trading 212 stocks and shares ISA. This account pays about 4% interest on uninvested cash and is tax free inside the ISA. So if we need the money, we can withdraw it in as little as 2 to 5 minutes, which is good because you don't have to worry about the money reaching your account in 5 working days. So our bank account stays empty, but we always have cash working for us in the background. Having said that, you will have a problem if you're only saving. And the reason why I'm saying this is because if you've got 200,000 in the bank, for example, and your yearly expenses are 20,000, you're not doing yourself a favor. The reason why is because the 10-year UK savings average interest rate was about 2.83%, and the average inflation over that same period was about 2.5%. So you are barely making it in terms of actually growing the real value of your money. So real growth is often close to 0%, and some years savings actually lose buying power. So if you're only keeping your money in savings account, you may actually be losing. The value of your money might actually be getting eroded every year, because if you look at it, some high street banks are offering way less than the 2.83%. You have current accounts offering 1.5% at the moment, and inflation at the moment is about 3.6. So if you can't keep all your money in savings accounts, where else can you put it so you can invest it? For example, if you invest your money in what's called the Amundi Nasdaq 100 to ETF, that ETF is giving about 15 to 20% a year over the last decade. And if we just use a conservative 8% return, and we say you put 10,000 into that index fund and you get an average return of 8%, that's 21,500 in 10 years. Now compare that to 2%. If you're getting 2% in a savings account, that will be 12,200 in 10 years. So you can see the difference. The difference is about 9,000, and we're just using 8%. If I use 15 to 20%, that can actually grow quite significantly. So compounding is good in that you get returns on your return. So our timeline rule is that for anything short term, we put it in savings, and we will put it in ISAs or high interest accounts. And then for medium term, 5 to 10 years, we will do a mix of savings uh, and low volatility investments. So that's your index funds and things like that. And then for the long term, which is 10 years plus, and this I know we normally do this in our sons Jais. For the long term, we usually put those in quality stocks. This helps in that you don't go and sell an investment that is supposed to be a long-term investment to cover something that is an emergency or short term. So you use your short term savings, your ISAs, that's where you keep your emergency fund, where you can quickly get your money, cover some expenses that need to be covered, and not have to touch the investments, because the stock market is very unpredictable. It can go down 20-30% in a bear market, and you don't want to be selling those investments if you are in a tight spot. The other thing as well in using the ISAs that I've been talking about in the UK is that you've got tax advantage. So ISAs, there is no tax on interest, dividends, or capital gains. It keeps your money compounding, and that 4% which I actually get from trading 212, it protects the value of that emergency fund, so it doesn't lose its real value if you look at it that way. For a recap, you need to save for emergencies. You can't do without saving. But if you're looking at the long term, you've got your emergency fund sorted, you will now have to divest and look at investing that money. And you will benefit a lot from using tax shelters like your ISAs, JISAs, where possible, and actually keep that money working 24/7. So if you've enjoyed this video, please give us a like, share the video with a friend, and comment your biggest money question in the comments down below, and I answer every single comment. Subscribe for beginner friendly videos like these ones, and see you in the next one. Peace.